All right, my clock shows 10 o'clock. I think we can get started here. Good morning, everybody. My name is Tyson Moore. I'm a supervisor here in the not-for-profit division at DWD. I want to thank everyone for joining today's webinar covering accounting basics for fundraising activities. With us today, as always, is Susan Berghoff, director here at DWD, along with our presenter and partner, Carrie Minnick. Before we get started, I have a couple housekeeping items to cover. For those of you who have questions during today's webinar, please use the Zoom's question and answer feature. You should see that option at the bottom of your screen in the toolbar. Both Susan and myself are going to answer questions periodically throughout the webinar. Also, Carrie's slides will be emailed to everyone attending today's webinar, along with being posted to our website after the webinar is finished. I think that's everything I need to cover. I'll turn the floor over to Carrie to start today's webinar.
Thanks, Tyson, and welcome again to everybody. Today, we're going to talk about some accounting basics related to fundraising and development. So I know some of you here with us are accounting staff and some of you are development staff. So we welcome you to today's session. And the things that we're going to talk about today is really a wide variety of different types of activities in the fundraising and development world and how they impact the organization. What kind of terminology we use, how those items get recorded in the actual accounting and that type of thing. So as you can see on the screen, here's today's topics that we'll go over, all of, again, these different types of mainly fundraising type activities. To get started with, we're going to talk about a gift acceptance policy. So would your organization accept all of these items? Cash, so obviously you probably would accept cash. That's great. Everybody loves to have cash. What about investments or Bitcoin or artwork or a building? So just because a donor wants to give you something, should your organization accept it? So some gifts may seem like a really good idea, but actually have some additional requirements or added costs that may make it more advantageous to not accept the gift. And that's why it's important to have a gift acceptance policy in place. For example, in order to accept donated investments, you have to have an investment account set up. So do you have an investment account set up where someone could donate investments to you? If someone wanted to give you a building, and let's say your organization does not currently own a building, are you able to support the ongoing costs of owning the building? The insurance, the maintenance, utilities, additional staff costs. Are there extra costs involved in renovating the building or making improvements so that it can be used by your nonprofit for its specific purposes? So that's why it's important to have something like this in place for your organization. I guess my question would be, do you currently have a gift acceptance policy in place? How many of you have one of these in place? If you don't have one in place, we do have a sample template that would be available. And just in general, it really gives direction to donors and staff to the types of gifts that an organization will accept. For example, if someone comes to you and says, hey, I have a building or I have a vehicle, I would really like to donate it to your organization. The gift acceptance policy that is in place will determine whether you can say, yep, we accept those. That's great. Thank you very much for your gift. Or our policy is that we don't accept real estate. So having that in place just makes it much easier for the staff when they come across those types of things to be able to respond accordingly. The gift acceptance policy should include specifically what types of gift will be accepted. Again, will you accept Bitcoin? Will you accept real estate, vehicles, land, that type of thing? Those unusual gifts aside from just the normal cash donations. It provides a consistent way to deal with those unusual gifts. And once you do put this into place, make sure that you communicate this policy to all of the staff and to your donors. So that way everyone is aware of it. It's not really useful to put a policy into place and then not communicate what that policy is, not use it accordingly. So along with those non-cash unusual gifts, that's what we're gonna talk about next, are non-cash contributions. So these are also called in-kind contributions. So there are different types of non-cash contributions that your organization can provide or can receive, I'm sorry. Inventory, property, equipment, supplies, food. So if someone were to give you donated inventory that you can sell in your store or to someone else, you would record that at fair value. Fair value is actually the amount that it would be sold if someone were to buy it, like out at the store. Also, you may receive equipment or different kinds of supplies or food that's going to be used within your organization. So a wide variety of types of non-cash, actual tangible items. If these items can be used by your organization internally, either for administrative purposes or for programming purposes, those are going to be recorded in your accounting at fair value. Again, the value that someone would go out and buy at the store. If these items are received and you cannot use them or you cannot sell them, they are not going to be recorded in your accounting for your accounting. However, you should always keep track of any in-kind non-cash contributions that your organization receives off of the books, just to make sure that you are accounting for that, because I know a lot of grants sometimes ask for that type of information. So it's good to keep track of everything that is donated to your organization, even if it's not included in your accounting. It doesn't meet the accounting standards. Another type of non-cash contribution that your organization may receive are those items, those fundraising items. So a lot of organizations will have a special event, a fundraiser, they'll have a dinner, and then they'll have an auction. So the items that they auction off are usually donated. So these items, again, since you're going to sell them, they are going to be recorded at fair value as of the date of the donation. So let's say, for example, I give you tickets to a football game. Let's Notre Dame football game or a Colts football game. So you would record those tickets on your books at the value that someone would pay for those tickets. Then when you sell them in the auction, that value is going to be needed to be adjusted up or down, depending on how much you actually receive in the auction. So for example, if the tickets, the fair value, someone would go and buy them, they would cost $200. Let's say they sell, then you would record it on your books in the accounting when those tickets are received at $200. But then let's say they actually sell at the auction for $250. So then you would have to increase that donation to $250 on your books. And we're going to talk about this a little bit more when we talk about special events. But the key thing to keep in mind here is that when you are getting those fundraising items from people, just make sure you're noting what they are and what the fair value is of those different items. As tangible items you can get, but you can also receive in-kind facilities and services. So for example, let's say you receive donated space, office space, or you receive donated space maybe to have one of your programs, then you would record that again at fair value as of the date of donation. Again, fair value is what someone would pay for it, pay for that item. And then services. Services is a little tricky because in order for services to be recorded on your books, the services need to require a specialized skill, and those that are providing it to you need to possess this, this skill. So for example, if you receive some legal services for something and you didn't pay for them, they donated it, a lawyer with a law degree donated some legal services to you, and you would normally have to pay for that. You would record that as in-kind contributions for your accounting purposes on your books. Again, you want to keep track of all that's donated to your organization, and separate from your books, but the things that get recorded in your accounting must meet specific requirements. Now, if someone were to come in and say, I would like to volunteer to answer phones during the day or to mail stuff envelopes, those do not require a specialized skill. So that time would not be recorded in your financial statements. However, again, you should probably track that just for other purposes. If someone were to provide services where they enhance a non-financial asset, you would record that value at fair value. So what that means is if you, let's say you are a nonprofit daycare center and you have you're getting a new swing set, a new play set, and you're going to have to pay for this if you're going to have to pay someone to put this together if you don't have volunteers come in and put it together. So you have volunteers come in and they put this massive swing set play set together. So that's an asset that you have, and the time that they spent putting that asset together would meet the requirement to record that on your books. Now you would have to record that at the value of what you would pay someone to put that swing set play set together. For example, if your auditor came out and volunteered and put this play set together, you would not record it at the normal hourly rate of the auditor. It would be at the value of what it cost to put that play set together. So what you need to take away here is that you can get non-cash contributions into your organization. There can be tangible items, inventory, property, supplies. There can be space, facilities, and services. Some of these are recorded in the accounting, on your books, and some are not. It just depends what it is. And we just need to make sure that we are keeping track of what is being donated to us, whether it's recorded in accounting or not, because it's just good to know how much support you're getting from volunteers and the community. And to also, send thank you letters for all of that. And for all non-cash contributions, items are only recorded in your accounting if you were going to have to pay for that anyways. So for example, if someone said, I am going to donate, $10,000 of marketing, we're doing this program and I'm going to give $10,000 of free marketing to a nonprofit, and your organization so happens to be the recipient of this. That's great. You got $10,000 of marketing. But if you would not have normally paid for that marketing, then you would not record it in the accounting. So again, just making sure that you're keeping track of what is donated, when it is donated, description to your organization. So we talked a little bit about the auction items. So many organizations have special events. They'll have a fundraiser every year, a nice dinner and an auction, or other types of events to raise funds for the organization. So when you have a special event, there are different supporting items that you receive that are recorded and should be tracked differently. So the first is a sponsorship. And it's also important to, when you're meeting with donors, contributors, the terminology that's used and the expectation that they are getting from their gifts. So for example, sponsorships. Sponsorship is, I'm going to sponsor this event. I'm going to give you X dollars for this event. In return, I may have my name listed somewhere as a sponsor. I may get some table tickets, something like that. But I'm not really expecting to get anything in return, like an advertisement. Where an advertisement in advertising, I'm expecting to get true advertising in return. It's important to know the difference between a sponsorship and an advertisement, because an advertisement is considered unrelated business income. And what that means is that income that you receive from advertising is considered not related to your main purpose. And so therefore you have to pay unrelated business income tax on it. And that's fine. You just have to be aware that you have to pay tax on it. So in order to determine the difference between sponsorships and advertising, really, if it looks like an advertisement, if you're saying, hey, go to XYZ company, they're great, they have great services, we really recommend them, that's advertising. If you're saying, hey, thank you XYZ company for supporting my event, that's fine, that's not advertising. You can use their logo, you're just recognizing them as a sponsor. So important to note the difference between advertising and sponsorships, along with donations coming in for special events. Normally, it will cost something to attend the event. So let's say you can buy a ticket for $200 to attend the event. Of that $200 ticket, in exchange, you're probably going to offer the person a dinner. So let's say I'm going to your annual event, it's a dinner and an auction, I'm going to pay $200 to come to the event. Of that $200 entrance fee, let's say $50 is going to cover my meal, and the remaining $150 is above and beyond the value of my meal. And so that $150 is considered a contribution, and the $50 is considered an exchange transaction, because I, as the attendee of the event, am getting something in exchange for my payment. It's important to know this because when you send out thank you letters to your donors, we need to make sure that we are noting what they are getting in return. And we'll talk about that in a little bit, about the different contribution substantiation that should be provided to donors. But when they go to donate or to file their tax return and claim contributions, they need to know how much of that ticket price is for a contribution versus an exchange transaction. So it's important to know, as you're planning for your special events, of the ticket price, how much is a contribution versus how much is an exchange transaction. And then again, we talked about donated auction items, how when people donate items to be sold, how you record those. But then also, when the person actually buys the item, they again are getting something in return. So they may not be able to receive a contribution deduction on their tax return because of the value of what they received in return. So again, when you're holding special events, it's important to figure out what type of support you're getting. Is it a sponsorship? Is it advertising? Is it a contribution? Is it exchange transaction? So that way you can make sure that the thank you letters that are going out to the donors are reported properly. But then also, if there is any kind of advertising, that is also reported properly as unrelated business income. All right, so that's special events. So other types of events that people have to raise money are bingo, casino game nights, raffles, other types of gaming events. So this is considered charity gaming, and I know a lot of nonprofits have these, which is perfectly fine. However, if you are considering to have a raffle and you haven't had one before, you might not know that you have to obtain a license from the Indiana Gaming Commission. So the Indiana Charity Gaming Commission is a state organization that is responsible for the oversight of these charity gaming activities. There is an exception, though, to obtaining a license. So if your raffle event, if the value of all the prizes awarded at the activity do not exceed $2,500 for a single activity and not more than $7,500 for a calendar year, you do not have to obtain a license. However, you do have to file a written notice with the Gaming Commission no later than 30 days before the first event of the year. So if you are planning a raffle, there needs to be some pre-planning done to make sure that you determine whether you need to file a license or not. And then if you do need to file a license, you need to get that done. But if you don't, you still need to file the written notice. And again, that needs to be done 30 days before the event. So making sure that that's planned accordingly. Also, when you do raffles, you have to set up a separate and segregated bank account for the raffle ins and outs. It cannot be included in your normal checking account. Raffle tickets cannot be purchased online. Raffle tickets cannot be purchased with a credit card. The tickets must be purchased with either a debit card, cash, or check. Also, if the event that has this raffle has an entry fee, so maybe there's a ticket price, but then you're also getting a raffle with that dollar amount, the entry fee cannot be paid with a credit card either. So that's something to keep in mind too. So if you're considering holding a raffle, just make sure that you know some of these requirements in order to make sure you're following the rules on holding a raffle. If you have questions, you can contact the Indiana Gaming Commission. I know I've called them and talked to them. The lady was very, very helpful. So I would recommend them. Sometimes it's difficult to get a hold of some people from, those government agencies, but when I talked to her, she was very helpful, called me back right away. So if you do have additional questions, obviously you can contact us, but if you want to contact the Indiana Gaming Commission, they do have an email, charitygaming@igcin.gov, or you can call them at 317-232-4646. So just make sure that if you are planning on holding some kind of charity gaming or raffle, that you find out what the rules are before you hold the raffle. Okay, next is contribution substantiation. So I mentioned this a little bit about when we're talking about thank you letters. So as an individual, if I give money, if I make a donation to a nonprofit, in order for me to claim it as a charitable deduction on my 1040, I have to have documentation to support this. So me as an individual, as a donor, I am actually responsible for obtaining this written acknowledgement from the nonprofit. However, it's really best practices, and I know many nonprofit organizations already do this, will go ahead and provide that documentation to the donors. It just makes it much easier for the donor, kind of takes that burden off of them. And really that requirement starts at $250. So if I were to give a $10 contribution, it's really not a requirement. It's probably still good practice though to send your donor a thank you with that information in it. If you have an exchange transaction, so again, if you have, for example, that special event where you're selling tickets, and let's say the ticket is $200, but $50 again covers my meal. So that includes an exchange transaction. Part of what I'm paying for is something what I'm getting in return. And if that ticket price is over $7,500, then it's actually the nonprofit organization's responsibility to provide written disclosure to the donor. So I think just in general, it's good practice to have a process in place to thank your donors, to provide them the proper documentation. And that proper documentation includes the items that are on the screen now, the name of the organization, the amount of the cash contribution. Now, if someone were to give you a non-cash contribution, you as the nonprofit should put a description of what was provided, but not the value. The value is valuing that item is up to the donor, not to the organization. You have to include a statement that no goods or services were provided by the organization in return for the contribution, obviously, if that were the case. If they did receive goods or services in return, you need to provide that dollar amount. So again, back to the $200 ticket to the special event. You would say, thank you for your $200 ticket. $50 of it was for the meal, is non-deductible, something like that. You don't have to include the social security number of the donor or the tax identification number. There is no IRS form for this. It is basically just what usually on the nonprofit's letterhead. You can provide this right after the donation is made, or you can provide it at the end of the year, or both, whatever you'd like. Some nonprofits I've seen have also added wording maybe to consult your tax advisor as far as, what is deductible and not deductible or not, putting that more on the donor versus the nonprofit. Also, the written acknowledgement, again, this could be It doesn't necessarily have to be on paper. It could be electronic, but it has to be, some kind of acknowledgement written as far as electronic or paper. But it must be contemporaneous, which means that you have to send these out before the individual files their tax return. Typically, organizations will send these out no later than January 31st of the year following the donation. So just making sure that you are filing those timely. I have seen different IRS cases where individuals have given a lot of money to a nonprofit and the IRS denied the deduction because the documentation was received way late after the tax return was filed, and they said, nope, it wasn't contemporaneous, so therefore you're not going to get that deduction. And we really don't want that to happen to our donors, so making sure that that you provide that timely. The next screen here just shows some examples of some thank you wording that you could put in those acknowledgement letters. Obviously, we want to put the name and of the organization, the date, that kind of thing. But here's some just examples too, as the wording, thank you for your cash contribution of $300. That then you would put in your organization's name, received on December 12th, 2021. No goods or services were provided in exchange for your contribution. So just kind of gives you some samples as to what needs to be included in those letters. So next, we're going to talk about restricted gifts. So when an individual or foundation, whoever gives money to your organization, it is very important that the donation be used according to the donor's intent, which is really why you need to keep supporting documentation from the donor noting any restrictions. Or as well as documentation showing that the funds were used for those intended purposes. So maybe a letter, an email. If you have an audit at the end of the year, your auditor is going to ask for these types of things. So it's good to have these in place. If maybe you are out meeting with a donor and they are verbally talking to you about a gift and having it restricted for a specific purpose, maybe just sending them a follow-up email and saying, hey, thank you, Mr. Smith, for meeting with me today. And, thank you for your gift of $20,000 that's restricted for program A. So that way you can kind of summarize what the discussion was about and have some kind of documentation to support that restriction if it isn't verbal. So when we're talking about restricted gifts, we have two different kinds of gifts, unrestricted and restricted. Obviously, unrestricted is the best kind of gift because you can use it for whatever you want. So there's no donor restriction. It can be used for operations. It can be used to pay someone's salary. It can be used for training, for programming. Basically, here, I like your organization. I'm going to give you $10,000. You can use it for whatever you want. Now, we also have restricted gifts where that is when a donor says, you have to use my gift for a specific purpose. So it could be for program A, it could be to purchase computer equipment, it could be for a specific period. Let's say it's for next fiscal year. The donor has put some kind of restriction on that gift as to what it can be used for. Only donors can restrict gifts. Development people, the executive directors, board members, none of those people can restrict a gift unless they're giving their own personal gift. But only donors can provide restrictions on gifts. And it is very important, again, that if a donor restricts a gift to your organization, that you make sure that those wishes are followed. So it is very important to have documentation what that gift is to be used for and to make sure that it is used for that. Now, we also have what's called conditional gifts or conditional grants. And with a conditional grant, you as an organization have to do something before they will give it to you. So a very common one is, I'm going to give you $100,000, but first you have to raise $50,000. So in that instance, the $100,000 wouldn't be recorded on your books as a contribution until you receive or until you raise that $50,000. So again, it's important to know if any of those are coming, if you've had any discussions with any donors as to whether there are any conditional gifts, grants coming in the future. As I said, only donors can restrict gifts. However, the board can designate gifts. So if you have money coming in that's unrestricted from the donor said that you can use it for whatever you want, the board can say, hey, we're going to set aside $10,000 of this unrestricted gift for future new building or for future starting this new program, something like that. The thing with with board designated gifts or board designated contributions is that they can be undesignated if they need to be used for something else. So there is a difference in terminology when we're using restricted and designated. A common restricted gift is an endowment. And in the term endowment is sometimes used differently by different people. So a true endowment is a donor restricted gift where I'm giving you, let's say $100,000 as an endowment. That $100,000 you can't touch. It's going to be invested, but you can use all of the earnings off of it for operations or for programming. Donor restricted endowments are regulated by the Uniform Prudent Management of Institutional Funds Act, MIFA. So that's why it's important to know if this is a true endowment or not, because if it is, there are certain things that the organization has to do. So when you're out meeting with donors and asking about giving to the organization, someone might say that they want to give an endowment. So it's just important to understand what they mean by an endowment. Does that mean that they want to give you certain amount of money where the earnings are used for something, a specific purpose or for operations? Or are they saying that the endowment, you can use part of that $100,000? So it's the communication, making sure that you're following your donor's intent. When you're receiving endowments, a couple things to make sure that you think about first. When you're placing funds in an endowment, that means that money is being set aside for future use as opposed to supporting the current activities. So nonprofit organizations can have a really large endowment, but be cash poor because they don't have enough unrestricted cash to pay for current needs. So it's important to determine whether or not you will accept endowments and to have an endowment policy in place. And again, if you don't have a policy in place and need an example, we're happy to provide that to you. So something to think about before you jump in, if you don't currently have any endowments, is that something where you can afford to put that organization or that donor's gifts aside for a specific purpose to be used in the future? Many times, donors will want to provide an endowment to an organization so that their gifts can continue on many, many years, maybe even after they're gone. So kind of gives them an opportunity to support the organization, not just in the current period, but also in the future as well. There's also what's called quasi endowments. And again, kind of similar to board designated gifts, the board can say, okay, we are going to take some of this money, unrestricted money, and put it in an endowment. This often happens when the board will put something aside in the community foundation. So they're saying, okay, we are going to put X dollars into a community foundation investment. It's going to be our quasi endowment, and we're going to just use the earnings off of it. So key takeaways with endowments is making sure the term endowment, that you understand what the terminology, what that means in your specific case, and then also having some kind of policy in place as to whether the organization will accept endowments and how they're going to spend them, what it's going to be used for, that type of thing. Another example of restricted contributions are those for capital campaigns. So I don't know how many of you have actually gone through a capital campaign or are planning to go through a capital campaign, but if you haven't been through one, capital campaigns take a lot of time and energy. So a capital campaign is basically, you're trying to raise a large amount of cash in a short period of time. Normally it's to purchase a building, to buy a building, to do some kind of renovation. It could be 3 to 10 times your annual income or more, especially for an organization that's just starting up that hasn't raised a lot of funds in the past. So the next couple of slides, I'm going to talk about just kind of some key things to think about as you're planning for the capital campaign. First of all is, can you take on a capital campaign? If you are struggling to meet your everyday operations, don't have enough people to take on the daily work, you probably aren't ready to take on a capital campaign, because again, this will take a lot of extra work and energy. Another thing to think about is, does the community have the capacity to support the project? Are there several other nonprofits that are going through capital campaigns at this time, and can you compete with those? Can the community support all of these capital campaigns at once? Make sure your leadership is focused. If your executive director is planning to retire next year or in the near future, now might not be a good time to take on a capital campaign, because you really want to make sure that your leadership is building key relationships with individuals in the community. So if you start that and then that individual leaves, that's going to hinder the campaign. Also, probably want to consider implementing a capital campaign committee to focus on what needs to be done, because again, this is going to take more time and effort. You want to make sure that you have a budget in place. How much do you actually need to raise? So you actually want to contact, let's say if you're building a building, your architect, your builder, you want to know how much this is going to cost before you start your capital campaign, because you need to know how much to raise. You're also going to want to consider inflation, increases in prices, because what the cost is now might not be the cost when you actually break ground. I don't know, that's something that you'll have to ask the builder. And then also, as far as the budget, can you maintain the building after it is built? So that's great. You raise all this money to build the building, but then are you going to be able to support the operations, the utilities, the maintenance, that type of thing for after the building is built? Also, you want to break down the goal between donors. For example, how much of your campaign is going to be from board members? How much is it going to be from key leaders? Those really big gifts versus a bunch of small individual gifts. You're also going to want to develop a case to give. Why should I, as an individual, support your organization? And why should I give you such a large gift for you to build this building? You really need to explain what the problem is. And it helps to not just what your organization's problem is, but how it affects the community and why your organization is the one to solve it and how you're going to solve it. Next, communication. So again, like we talked about, restricted funds from donors, making sure that donors' wishes are followed for what their donations are used for. When it comes to a capital campaign, the cost incurred during a capital campaign usually includes some fundraising, marketing, construction, design, maybe repayment of debt. While most donors understand that a portion of their gift to the capital campaign may cover these campaign costs, other donors might want their entire gift to go just to the building. So it's important to include the proper wording on those solicitation documents that clearly specifies what you're going to use these capital campaign contributions for. For example, is it just for the building? What happens if you have excess? What will you use that for? Will it be to maintain the building going forward? Will it be for operations? You need to clearly communicate what you're raising these funds for, because that is what the donor believes their gift is going towards. And then that's what it's going to be restricted for. And then lastly, follow up, making sure obviously that you thank your donors, have a celebration or a groundbreaking. Now, one thing to keep in mind is that you don't want to break ground too early, because if you've only received 50% of your campaign goal, your donors are going to see this building already going up and think, why do you need my gift? Your building is already built, so you must not need any more money. So making sure that that is timed properly. And then also be active in collecting the pledges. So a lot of times when a capital campaign happens, people will promise to give you a gift over a certain period of time. Maybe I'm going to give you $10,000 over 5 years. So sometimes people might forget to make that payment. So you want to make sure that you remind them that, hey, it's time to pay, to pay that pledge that you said you were going to pay us. So making sure that you follow up with them to collect those pledges, because it's very important. That's part of your money that you raise, and you want to make sure that you do get all of that. Speaking of pledges or promises to give, there are different ways things get recorded for accounting depending on the terminology. So although promises to give or pledges to give and intentions sound the same, they are not and are accounted for differently. So you need to consider what type of wording is included on pledge cards, especially for a capital campaign. So if your pledge card says that I promise, or I commit, I pledge, that means it's good to go. You're going to record this as a receivable on your books in accounting. That means it's going to be recorded as revenue, and it's going to be recorded as something that somebody owes you. If your pledge card says I intend to, or it's subject to availability, this is not a pledge. This is not a promise. So therefore, it would not be recorded. So it is very important in the regards to collections. So if you have all these promises, you're recording them on your books, but then people come back and say they can't make this payment, then you're going to have to write off all of those receivables as uncollectible. If you have all these intentions and people intending to give you all these gifts, but then they come back and say they can't do it, then there's no effect on your book. So again, it's just important to determine what wording you're using on these types of gifts to make sure that they are recorded properly in your accounting. So next, I know a lot of times people talk about the development department versus the finance or the accounting department. Both are super important to the organization. Both are, trying to do their best to meet the mission of the organization. They just do it in different ways. And a lot of times nonprofit organizations, the development or fundraising department will have one type of software to track their gifts and grants. And the accounting or finance department will have another type of software. And that's great because they're doing two different things. However, you really just want to make sure that you can reconcile those two reports because a lot of times there will be differences. For example, like when we talked about the promises to give, are they being recorded? They're recorded a certain way for accounting purposes, but how are they recorded in the development department? All at once or when they come in? So it's just important to know how the things are being recorded between the two departments, and they can be recorded differently. They will be recorded differently. You just need to communicate and make sure that you can reconcile the two different reports. Otherwise, it's going to be very complicated and confusing for the board when they see those different reports. And again, we talked about terminology, making sure that everyone is aware of what a promise to give is. A present value discount, it basically just means if someone is going to give you money over 5 years or more than 1 year, $10,000 today is not the same as $10,000 5 years from now. And so there's a calculation that needs to be done for the accounting department to recognize that. Allowances for collectability. So again, Do you think that you will collect all of these promises? Again, that's something that the accounting department has to consider and take into account. Conditional gifts, we talked about that. Wills, for accounting purposes, wills, gifts that are, if someone says, hey, I left you X number of dollars in my will, that's great, thank you, that's awesome. However, it does not get recorded in your accounting until the will is actually probated, because wills can change. So again, just making sure that communication is key between the two departments, and making sure everyone understands how things are to be recorded. And then the last thing I wanted to talk about is using your 990. And again, if you're a development person or a fundraising person, this might seem a little too technical, but I just want to kind of give you an overview of your 990, because your 990, if used properly, is really a huge marketing tool to generate donations. Most nonprofits are required to file Form 990. So this is your annual informational return that's filed with the IRS. Unlike a for-profit entity, the 990 is open to public inspection. So that means anyone at any time can go out on the internet and pull up your 990, and it's going to have a lot of different information on it. So do you know, as a representative of your organization, who is looking at your 990 and why? So the media, different foundations, donors, the IRS, watchdog groups, prospective board members, other nonprofits, they all look at your 990 for different reasons. They want to gain additional background and information on an organization. They want to see where you're spending your money, where you're getting it from. So it's important to make sure that what is reported on your 990 gives an accurate picture of your organization. I'm not going to go through the 990 page by page. That would be just overwhelming for this session, but just wanted to give you a breakout of what is on your 990. And as you can see, there's not, I mean, we do have some, revenue, functional expenses, balance sheet. Those are the numbers, but there is a lot of non-number information that goes on your 990. They want to know about your board, your programming, what you're doing, what you're accomplishing, that type of thing. So just wanted to go over a few different areas of the 990. So this is the top part of page 1 of your 990. And again, you may have seen it, you may not have seen it, but as a development person or a fundraising person, it's best to have the 990 completed as a team, because the accounting department is probably not going to have all of this information. So I've highlighted a couple of key lines. Describe the organization's mission or most significant activities. This is the very first thing that people look at when they pull up your 990. So you want to make sure that this wording gives a good description of what you're doing. Because again, as a potential donor, I can go out and look at your 990. Do I want to give to this organization? Let's see, what are they doing? Number of volunteers. So how many volunteers, unpaid people, are supporting your organization? So this is really showing how much community support you're getting. Page 2 of your 990, this is a really big section, number 4 here. Describe your organization's program service accomplishments for its 3 largest program services. This is really your opportunity to brag on what the organization has accomplished during the year. How many people did you serve? How many classes or programs were offered? Don't just repeat the mission. Use numbers. Don't feel limited either to just these lines. You can go off onto a whole nother page. But the key here is to really, maybe you should involve your program person, your marketing person, your development person in crafting what this word should be. Because again, this is where you're showing your donors what you did with their money during the year. So donors, thank you for supporting us. You gave us this money. Look what we accomplished during the year. So again, really your opportunity to describe to the public what you are doing. On this page, page 5 of the 990, there is a question about can the organization receive deductible contributions? So if you're a 501c3, yes, you can. But then it's going to ask if you received a payment in excess of $75 made partly as a contribution and partly for goods or services. And did you notify the donor of the value of those goods or services? So that goes back to those exchange transactions where I'm paying $200 to come to your event. Of that $200, $50 is for my meal. The rest of it is a contribution. Did you notify me that $50 was non-deductible? That's what it's asking there. And then next, this talks about your revenue. So again, on the 990, there is a spot that asks about fundraising events. So those are your special events. So that's why it's important to track the money coming in. There are two different lines on this return on this page for fundraising events. One is the contribution part and one is the exchange transaction part. So again, that's why it's so important to know how much of each ticket is for that, because we have to report it to the IRS. If you look at your organization's 990 and you look on line 8C there where it says net income or loss for fundraising events, it will likely show a loss. That is okay. The IRS is expecting there to be a loss here. That is just saying that you are getting contributions, which are going to be reported on a different line that are going to cover some of those costs. So just wanted to let you know that if you do see a loss on this line, this does not include all of the revenues and expenses for your fundraising event. It only includes some of them. And the IRS expects there to be a loss there. And then looking at your page 10 on your functional expenses, nonprofits have to allocate expenses between 3 different components: program, management in general, and fundraising. Normally, all nonprofits should have a program, should have management general, and should have fundraising expenses. When a donor looks at your return, they're going to look to see how much of your expenses are in the program column. They want to see 60, 65, 75% of your expenses going to program. So it's good to, if you haven't looked at your 990, to take a look at it and see how much is going into each of these different columns. The last thing about the 990 is you do have to report certain donors to the IRS. So normally $5,000 or more. There's also a calculation in other circumstances, but you do have to report the name, address, and dollar amount of those donors that gave $5,000 or more to your organization during the year. So that's why it's important to track the donors' names and addresses. This page, I said that the 990 is open for public inspection, so anybody can go out and look at it. This page is the names and addresses of your donors on this page are not open to public inspection. So if you have a copy of your 990 on your website for people to look at, make sure that the names and addresses of your donors are not included here, because we don't want to tell everybody who's donating to our organization. Also, the IRS does not like anonymous. If you have somebody that donates to you and wants to remain anonymous, that's fine. You don't have to post them on your website or anything like that. But for IRS purposes, on this page that is submitted to the IRS, we really need to know that person's actual name and address. And then finally, not so much, somewhat related to the 990, but just as an aside note that you should probably know as far as, raising money for your organization. When a nonprofit organization first becomes a nonprofit, they are considered by the IRS to be either a private foundation or a public charity. A private foundation gets its money, support, contributions, donations, grants from a single source or a very small amount of individuals. For example, Bollinger is a private foundation. They got all the money from one family. A public charity gets its money from a bunch of different donors. individuals, a bunch of different individuals, a bunch of different foundations, maybe other nonprofits, businesses, corporations. Each year when your organization's 990 is filed, there is a test to determine whether an organization continues to be a public charity or a private foundation. So all of you that are 501c3 organizations that are, Ronald McDonald House, Big Brothers Big Sisters, the zoo, those type of organizations, you're public charity. You receive your money from a bunch of different sources. You want to make sure that you continue to receive your money from a bunch of different sources, because if you were to not, and the IRS said that you received your money from too little of different people, then you could become a private foundation. If you became a private foundation, there are different rules and taxes that have to be filed. So if you are a public charity, you really do not want to become a private foundation. So just wanted to make you aware that when you're raising money for your organization, you really want to not only diversify your funding sources in case one of them left, and then you'd have to figure out what to do, but also because there is a rule that says for public charities that really you need to get your money from a bunch of different sources. So just making sure that you are aware of that. That is all that I have today. I don't know if there's any additional questions that anyone has at this time. You can go ahead and put those in the Q&A. If not, I think Tyson will wrap it up.
Yeah, there was one good question in the chat that maybe you can touch on, and Susan answered it, but maybe we can answer it for everybody here. If you have leftover restricted funds, what are your options for those funds? I think it's a question I've been asked a bunch too.
Right. Yeah. So technically, if you have restricted money, so again, this is money that a donor gave to your organization, and they said that it was supposed to be for a specific purpose, you have to spend that money for that specific purpose. If maybe they said it was to purchase computers, you purchase computers and you have leftover money. They gave you more than what you needed. You cannot just automatically throw that into operations. You really need to go back and ask them if you can spend that for operations, or if you can, maybe they'll restrict it for something else. So really, you really need to go back and contact that donor and ask them, okay, we spent it for this, but we had some left over. Can we use it for XYZ, or can we use it for operations? Again, making sure that you're following the donor's intent in their contribution to your organization. Yeah, that's a really good question.
And there was a follow-up on that ad said, it's gray. Can we use it, or can we determine that we're going to use it for maintenance or something like that of what they told us we could purchase? I'm like, yeah, you could do that, only you really need to ask first. Mm-hmm. I think the communication is the big key there. Ask your donor. It'll make them feel like you're doing what you need to do to make sure that their wishes are fulfilled.
And again, I think that goes back to communication with your donor and having those relationships with your donor, being able to go back and ask them again to make sure that their wishes are followed.
Yeah. Any more questions, or did we cover most of those, Susan? Looks like you answered all of them.
I answered all of them. Our chat wasn't working, unfortunately. So I did get to answer everything that was on the questions, the Q&A though.
All right, great. All right, I'll close this down here. Just as a reminder, the session was recorded, so the slides and videos will be available on our DWD website in the not-for-profit section. A link to the section will also be emailed out to everyone attending today. While you're on our DWD website, visit the not-for-profit webinar page where you can register for our next webinar. It'll be on September 14th, and it's going to cover your organization's online presence. With that being said, I want to thank everybody for joining this morning, and have a great rest of your day.